number one is that trading in the car and rolling the negative equity into a new loan is an option, but it's going to come with risk. Okay. Number two, this increases your new loan amount, which could put you upside down again if the new car values drop too quickly. So for example, if you have the car that you owe $15,000, but it's worth 10, you put no money down. Now you're carrying over $5,000 on a brand new car. Most cars are... Hello everyone, today we're going to talk to you all about if you have an upside down auto loan and what you need to do. Let's get right into it. So in this video, here's what we're going to cover, okay? Number one is understanding your auto loan situation. Everybody's situation is going to be a little bit different. Some of you all have had your cars for a short period of time. Some of you all have had your car for quite a few years. Don't worry, we're going to break down what your options are. Then number two, if you should consider keeping your car and how to pay it down properly. I know what you're thinking, Calvin, I've been paying my car loan. Yeah, but there's certain ways to do it that can still save you money and get you out of the situation a little bit faster. And then also too, we're going to go over what that looks like to consider refinancing. And I got some refinancing options for you as well. Then of course, selling the car and covering the difference. We'll go into what this looks like. Then, of course, rolling the negative equity into a new loan. This is very common, and I'll break down to you all what this looks like as well. And then, of course, how can you avoid future upside down loans as well, too? Let's get right into it. So number one, you need to understand your loan situation, okay? Being upside down means that you owe more on the car than the car is worth. So, for example, let's say you have a car and the loan on the car is $15,000, but the car is worth $10,000. This means you have negative equity, or also known as being upside down on a car. Number two is that you want to check your loan balance and compare it to your car's current market value. Now, popular sites are going to be Kelley Blue Book, even though most dealerships use something called the Black Book, so which is crazy. Or you can also call a dealership too and kind of get an estimate of that as well too. A lot of dealerships nowadays have these trade-in calculators that give you an idea of what your vehicle is worth. A lot of those calculators do have the Black Book values attached to it. And also you can also stop by the dealership as well too. Now, here's another thing that people don't do, and that is trading the car in with the automaker, okay, or selling it to the automaker. Now, of course, a dealership would love for you to buy and sell with them. But let's just say, for example, you have a Mercedes-Benz, okay, just throwing some random cars out there. But if you have a Mercedes-Benz and you want to trade that car in, then you can actually get, usually you can get a little bit more for it if you're trading it in with the automaker. Why is that? Because when people go to Mercedes-Benz and they want to get a newer model, but they can't afford that newer model, then they're going to sell them a pre-driven one. So again, that's where they have a little bit more value. Now, don't get me wrong. Value is going to be value at most dealerships. But that's, again, if you're just trading it into a place that only sells used cars, that may be a little bit more value there. But again, if you're selling that Mercedes-Benz at a Nissan place, the chances of someone coming there specifically for a Nissan and then getting swapped into a Mercedes is going to be a little bit different. OK, and but if it's just a luxury car spot, again, this is where you just want to get an idea of where of how much you're going to end up getting. OK, then number three, this will give you a clear picture of the gap that you need to address. Essentially, the difference between what it's worth and what you actually owe on the vehicle. By the way, if you're looking to get a bad credit auto loan anywhere nationwide, these are dealerships that specialize in bad credit auto loans. Yes, all credit scores can apply, and the process is pretty fast. They also have some low down payment options or no down payment options. Obviously, you must qualify. If you want to learn more or apply today, go ahead and scan this QR code to do so. Now let's talk about the benefits or how you can actually keep the car and then pay it down. So if it is possible, obviously financially, you have to be able to afford this. Hold on to the car and focus on paying extra towards the loan principal. What does that mean? That means that if your monthly payment is, let's say, $400 a month, okay, you want to go ahead and start paying $425, $450, $500, upwards of $800. It doesn't really matter. There is no such thing as, a minimum amount that you should pay more than, okay? But obviously something where you can see a difference. And to see a difference, I would say try to see if you could double up that payment. If you can't do that, try to at least add about 20 to 25%. So in this case, like another, anywhere between about 25 to $100 on the low end, 25, but at least about $100 a month if your car payment is about $400 a month. And that's just paying extra when you can. If you can't or it's difficult for you, it's not the end of the world, but this is one of those methods. But also too, reducing the loan balance faster in general can close the gap between what you owe and the car's value. So let's say, for example, you can't do this on a monthly basis. What about when you get your bonus from your job, or if you get a certain amount of money when you get like a tax, if you get like an income tax return, right? You could throw $2,000 at this, $4,000 at this. There's nothing wrong with wanting to pay your car off faster, because the faster you can pay that off, not only the amount of money that you can save as well too, especially being upside down, but the quicker the amount of time that you can get to without having to pay a car payment. Okay. And this is often the least expensive and simplest option to go. Another option would be to consider refinancing. Okay. Now, if your current auto loan has a high interest rate, refinancing may lower your monthly payments. Okay. So now what does that mean? That means if you have, let's say, for example, same example, you owe $15,000, but the car is worth $10,000. There's a couple different things you can do, and I'll give you an option to do that as well too. So a typical auto loan refinance is essentially taking what you owe on that vehicle, right, $15K, and then giving you better terms. Now, does that mean that you have to start over? Technically, you are starting over, but it's a start over with a new loan. That doesn't necessarily mean, let's say, for example, you are paying $400 a month. Okay. You owe $15,000. And let's just say you've had it for, you signed a 6-year auto loan. I know I'm just using some random numbers, but I'm going to keep up with this. Okay. So a 6-year term. Now you've been paying on that for 2 years, which means you have 4 years left because you started out at 6. Are you with me? Okay. So some people would consider a refinance starting over if they have to go back to 6 years with this new balance, which is like $15,000. And they say, okay, now I got this $15,000 that I owe, but I don't want to start over at the 6-year mark. You don't have to. Some of them may give you the option to continue where you are, which is 4 years, and you just keep making the monthly payments. Some of them will let you stretch it out, to 5 years or 6 years, again, to lower that monthly payment even more. Okay. So it really depends. Everybody's financial situation is a little bit different. You got to make sure that the numbers make sense to you. Okay. I've always told people to go with the amount that you can afford and see which amount that you can actually put more into it. Okay. So that's just another way to look at it. Then also, number 2 is that you can use the savings to pay down the loan faster or reduce the financial strain. So again, when you're refinancing, in most cases, since you're either stretching out the term or essentially getting a better interest rate, this is going to lower your monthly car payment. So now, instead of a higher portion of that going towards the actual interest only, and you'll be able to get more towards the actual principal. Some people feel like, well, I'm starting over the loan. Isn't more of the monthly payment going to be going towards the interest? Yes, but at the same time, you're getting a better interest rate. So yes, some of that is still going towards the interest, but not as much as before. Some of you all are about 80 to 90% of the monthly payment was going towards the interest. Now it's about 40% of it or 50%. Whereas if you would have stayed in that original auto loan, you may be at 70 to 80% of that monthly payment still going towards the interest. So again, you got to look at the numbers, make sure it makes sense to you. Number 3 is ensure the new loan doesn't extend the term too far. For example, if you're at 4 years, you can go 5 years if you want. You can stay at 4. You can even go down to 3. So it's really up to you, but you don't want to be making it more like so far out, like 7 years. And yes, some banks do still do a 7 years, as this could worsen your upside down position. And also, if you're looking to refinance your auto loan, lower your monthly payment, this is a great option for you. There's no impact on your credit score to see the terms and the rate. So that means that once you go to this website or scan the QR code, however you want to do it, then they'll be able to let you know what your monthly payment is going to look like, what your interest rate is going to look like without any effect to your credit score. If you decide to move forward, then it will be a hard pull because they need to confirm what they saw on the soft pull. Now, the minimum credit score needed to do this is about a 580. They also give low interest rates available, and it's a fast process and as well too, and a cosigner can be added, which is 100% optional. So if you want to learn more, scan this QR code or click the link in the description below. Now, another option is selling the car to cover the difference. Okay. So selling the car may help if you can afford to pay the difference out of pocket. So for example, going back to the same numbers, your car's worth 10,000, you owe 15,000. If you sell it on the street for $10,000, then you still have to make a $5,000 payment to the bank that you are currently paying right now. Why is that? Because you can't sell something that you don't own. So that's where that title is going to come into play. Okay. And so in order for you to get that title, you have to make both of the exchanges at the same time. And then some people have just taken money out of their savings or whatever, paid the car off and then just sold it, for whatever. But again, you don't. The problem is especially when you're selling it like on the street, it's such a huge amount out of pocket that you have to make work. Even sometimes with a refinance, some banks may not refinance the full amount that you owe. If you owe 15,000, the car's worth 10, they may give you 11 or 12, and you may have to pay the difference out of pocket. So keep that in mind as well. Also, this is going to eliminate the burden of being upside down, and this is going to allow you to start fresh. Okay. Then number 3 is that is going to ensure that you have a clear plan to cover any remaining loan balance after the sale. Okay. Because again, if you're not able to do this, you're more than likely going to make sure that because some people obviously want to get the title right when they buy it from you. So you may have to make a prepayment and then get a payoff and then show that payoff and then let that person know, hey, listen, I'm going to make this arrangement with you. But some people don't want to buy it like that. They would rather have it where the title is in hand. Next is that you can roll the negative equity into a new loan. Now, this is probably the most common that I've seen, especially working at a dealership for 6 years and seeing a lot of people doing this. Sometimes the numbers make sense, sometimes the numbers don't, but we'll break it down. Okay. So number 1 is that trading in the car and rolling the negative equity into a new loan is an option, but it's going to come with risk. Okay. Number 2, this increases your new loan amount, which could put you upside down again if the new car values drop too quickly. So for example, if you have the car that you owe 15,000, but it's worth 10, you put no money down. Now you're carrying over $5,000 on a brand new car. Most cars are going to lose value anyway. So now you're adding more to your loan and you're already starting off, with that. However, now that you have a newer car or a new car, this is also going to be easier to refinance. So then here's another thing too, guys, is that refinancing an auto loan, there's no limit. I've seen people refinance their auto loan 2 or 3 times within that 4 to 6 year period. So again, especially if you're with a credit union, because they want that fresh loan. At the end of the day, the banks love new commitments, new loans. Okay. They need a refresh on money. It's nothing wrong with that. And as far as like affecting your credit score, it's not the end of the world. The whole purpose of having credit is to obviously use the credit. So someone's going to obviously have to take a look at it at some point. Okay. And number 3, you only want to consider this if absolutely necessary and if you need a different vehicle immediately. Keep in mind too, with dealerships, especially with newer vehicles, and I've seen this mainly with new vehicles, but I've also seen pre-owned vehicles have some specials as well too, like $500 to $1,000, of equity, or essentially is what they call a rebate. And that rebate then gets applied to your negative balance. So let's say, for example, you're getting a new car, and your numbers are the same. Your car's worth 10,000, but your loan is 15,000. So you got $5,000 worth of negative equity. I've seen car dealers, or I would say car manufacturers, offer $3,000, $4,000, $2,000 of a rebate. So let's say you get a brand new car and it's giving you a $3,000 rebate. That means that $3,000 rebate is then going to be applied to the negative equity. So you remember you had $5,000 because your car was worth 10, you owed 15. Now, of course, that's $5,000 worth of negative equity. With this new vehicle rebate, that's going to be 3,000 minus 5. Now you're only carrying over $2,000. Okay. So that's going to help out big time Or another way to look at it is instead of having to put down 5,000, if you had to put the money down, instead of putting down 5,000, now you only have to put down 2,000. Or another way of looking at it is that $2,000 is only what's going to be carried over to affect your monthly payment. So that's exactly why again, it's the most popular way to do it, because in most cases, you don't have to put any money down. You're just rolling it over. But that doesn't mean that you don't need to refinance, especially if your interest rate is not looking a certain way. Now, if you don't mind keeping this car for a while, you may not mind resetting it just to keep the payments low, or just simply paying more on the monthly payment. Either way is going to be up to you. Now, how can you avoid doing this in the future? Number one, it's going to prevent this from happening again. Aim for shorter loan terms. Okay. Just because they can give you 7 years or 6 years doesn't mean you have to take it. Okay. And also potentially looking at or considering making a larger down payment. I've seen people, it's not uncommon. I would put it to you like this. People that typically have higher credit scores or higher savings, they know the benefits of putting down 5,000, 10,000, but obviously you have to have that to do it. Number two is considering choosing a car with a strong resale value to minimize depreciation. This is usually going to be luxury vehicles or vehicles that have a lot of equipment in them. Okay. When you have top of the line vehicles or vehicles that are essentially the most expensive of that trim, then usually it's going to be a little bit easier to, get rid of. But of course, especially if it's a luxury vehicle. Okay. And then, of course, you also have to be mindful of these factors will help you stay. Being mindful of these factors will help you stay in a healthier financial position, because if you know how much you owe, if that means you also know how much you need to start bringing it down as well. Thanks for watching, and we'll see you guys on the next video.